All right, so we got a powerful one coming on this live stream this evening. Going to be talking about no doc business funding from a different angle. We're going to be discussing some significant changes that's going to be coming from SBA and the overall government agencies behind that, and how SBA changes are going to impact business funding all the way down the line, including no doc funding, and how no doc funding probably contributed greatly to some of the changes that are coming in 2025 when it comes to the SBA lending and SBA funding. So we're going to dive into some of those shifts and changes. And then we're going to be talking about, why no doc is still a primary option for many of us that are entrepreneurs or aspiring entrepreneurs. We're also going to be talking about how to still find no doc programs. We're going to be covering, touching lightly on application sequences and things to say during your application process, or when you maybe are requesting certain limits or dealing with reconsiderations. Big banks versus small banks. This is a big debate in the business lending space. So we'll be talking about, what business funding and no doc funding looks like, big bank versus small bank, and how to exit no doc business funding. And of course, again, we'll tie up with the SBA funding as well as we get into the mix. So we'll be covering some interesting and some valuable information as always in this live stream. I'm gonna do my best to keep it concise as always. For those of my pioneers who are familiar and you're wondering why I sound a little strange, I am definitely sick. Could be one of these 15 million COVID variants that are out here, but either way, the show must go on. Wednesdays is one of our days, so gonna push through, but I'm definitely gonna try to keep this one concise. So let's get into the SBA changes and funding changes and how that's going to branch over to the conventional market with stuff like no doc loans, et cetera. And again, for all my pioneers that are coming in, welcome back in. Credit Guzzler, my guy. Good to see you coming in the building. For those of you catching the live stream, make sure you like, let me know you're in the building. If you're catching the replay, leave a comment, let me know you're in the building as well. Let me know what questions you might have going into this around SBA funding or no doc funding. We'll be covering a lot of information. And, to all my pioneers, welcome back as always. For those of you who are new and don't know me by chance, I am a retail banker, business banker by trade. I spend a lot of time with consumer clients and small business clients, everybody from just starting out all the way up to high net worth individuals. And you are getting content that's going to help you master your relationship banking and maximize your borrowing capacity on this channel. So again, tonight we're covering SBA funding and how that's trickling over to no doc funding and changes that are coming. And we're going to branch out into how to maximize no doc funding and get access to it still and continue to push forward and to better position ourselves for SBA funding going down the line as well. So significant changes coming to business lending overall, including SBA funding. Taking effect in 2025, there's technically been no true no documentation programs necessarily out there at scale, especially with the SBA. You have some smaller institutions and alternative lenders that have no doc, but these changes will make even low documentation and SBA-backed funding more difficult to acquire and will require more scrutiny from lenders. So the changes, which are largely a reversal of more relaxed policies from previous years, are aimed to restore stricter underwriting standards and tighten eligibility requirements. This impacts both SBA guaranteed and conventional loans, as the overall market is affected by tighter federal policies. So we got some real changes coming. And again, that's SBA government-backed and non-SBA government-backed conventional business funding, which for those of you who may not be familiar, conventional falls in the bucket of your standard private bank, alternative lending even, et cetera. It's going to be anything basically in the private market outside of the SBA funding. So stricter SBA underwriting standards are going to come. The SBA eliminated the flexible do what you do standard, which allowed lenders to use their own credit criteria for certain loans. This new policy, effective June 1st of 2025, re-implements more rigid federal underwriting criteria, making it harder for lenders to make judgment calls on unconventional applications. So that's a big one right out of the gate. Up to this point in time, or up to June 1st, lenders had the ability to create their own credit criteria and standards. Excuse me. And, this change is going to make it harder for institutions to do judgment calls on unconventional lending applications. So basically, the government standard is changing, and it's going to be overreaching private standards and individualized criteria, which is going to, again, spill out into conventional lending. So this is huge. IRS transcript verification. This is another big one. Lenders are now required to verify applicants' financial information directly through IRS tax transcript for all SBA loans. This eliminates the simplified documentation that was previously allowed and makes true no-doc or even low-doc SBA lending impossible. So basically, and again, as I keep saying, everything I'm going over, you can expect on some level to spill over to conventional private funding, business funding options. So again, the IRS transcript verification. Lenders are now required to verify applicants' full financial information directly through the IRS transcript for all SBA loans. Increased scrutiny of ownership. Eligibility rules have tightened to address fraud and taxpayer liability concerns. For SBA loans, all owners, guarantors, and key employees must now be U.S. citizens, nationals, or lawful permanent residents. This replaces the previous standard of 51% ownership. So previously, if you had the properly documented, U.S. citizens or lawful abiding permanent residents, if it was 51% of you that were, then the other 49% didn't have to be. So this is clearly going to be impactful for anybody migrating to the country or immigrating or people who've been here but just haven't been documented all this time. This change is now going to make it where full-scale 100% ownership has to meet U.S. citizen, national, or permanent resident status. So that's a game changer for anybody that was, operating a business in partial or in full without full legal immigration or documentation rather. So that's a big one. Reinstated collateral requirements. For SBA loans, the threshold for requiring collateral has been lowered from $500,000 to $50,000. For many loans, this increases the need for scrutiny, making lending riskier and more restrictive for borrowers. So now if there's less of a collateral requirement, basically a downsizing of 10x. It was $500,000, now it's $50,000. With that change, what they're basically saying is now it's riskier and more restrictive because they don't have something tangible to hold on to for default. So now we have to do more work on credit requirements, income requirements, revenue requirements. You see what I'm saying? We don't have something tangible that we can put our arms around if you were to default because the SBA has lowered its threshold on collateral requirements. So that has an inverse effect, if that makes sense. Emphasis on ability to repay. I've talked a lot about this on this channel. Following the 2008 financial crisis, regulations like the Dodd-Frank Act introduced ability to repay. Today's no-doc alternatives, such as bank statement or asset-based loans, still require lenders to verify that the borrowers can reasonably afford their loan, eliminating pre-crisis style no-doc lending. So this is more going to the 2008 crisis, but you'll see an emphasis going forward where there'll be a bigger push to do some kind of additional verification or ability to repay, even if the program or the lending program or the lending product is trying to leaning on some type of collateral or asset or et cetera. So basically what they're saying is no doc as we've seen it is under a lot of pressure, basically. So there's obviously still caveats. You're going to have bank statement loans, asset-based loans, that'll be out there in the marketplace from alternative lenders. But what I do see is this is going to make traditional brick and mortar bank no doc funding options more stringent, meaning traditional brick and mortar banks are a lot closer to these changes with SBA and government regulations and policies. Your alternative fintech lenders that are cropping up all over the place are going to be further removed from these changes. They're going to probably feel the effects of it because a lot of them are funded and being ran through traditional banks, believe it or not. A lot of these companies aren't just completely organic. A lot of them are just back-end projects and you know, opportunities for these traditional banks to get market share in a market that their standard traditional bank format can't get their hands on, if that makes sense. So a lot of these fintech companies are a bit more removed, but traditional banks that we're used to dealing with are going to be a lot more subject to these SBA changes and that spill over to the conventional market. So that's going to be big. Now I wanted to shift gears really quickly. So y'all leave y'all comments down below and let me know what y'all think about those SBA changes, because they're a pretty big deal. So why is no doc funding still so appealing for many of us? Well, to be completely frank, full documentation funding loans are pretty stringent and demanding. And there's some very legitimate entrepreneurs and business owners out there. And I experienced this firsthand because, again, I'm a business banker. I help with business lending requests. Even when you have a legitimate business bringing in revenue and you've been doing it for a year or two, multiple years, et cetera, getting everything in order that is required for full documentation, think, SBA or high level traditional brick and mortar financing, getting everything in order that they require is still hella demanding. I mean, hella demanding. You're talking about tax records. You're talking about balance sheets. You're talking about, cash flow statements. You're talking about, personal finance statements, a lot of documentation and bookkeeping. And many business owners are not bookkeepers. And a lot of times your operation may not allow you to have a bookkeeper or an accountant on full time to have all of this polished and done up for you along the way. But you still need access to capital. And so whether you're starting a business or you're growing or sustaining an existing business, no doc funding has been that bridge or that short-term stopgap to give us options when we don't have it all together for the rest of the funding options that are available. So full doc, mid-doc level programs. And we can be transparent on here and make it abundantly clear. No doc programs have really largely been business credit cards for the most part. Now, we do know that there's financial institutions that have legitimate, business line of credit options, and we'll talk about that in a minute. But the majority, well over 50% of the no doc that we've been talking about and dealing with for years now has really just been business credit cards for the most part, especially if you don't have assets or bank statements to go off of. You really are narrowed down for the most part to personal guarantor business credit cards. So this has given most of us some kind of segue and some kind of breathing room to be able to either start, launch, or sustain a business or grow a business when we haven't had everything lined up to go through the traditional and conventional, in the high scale conventional means. So other things that are impacting the no doc funding program and the SBA funding program, and because I'm sure the economic environment is quite unstable in the current times right now. And the political environment has stirred that up even more. The economic environment is an environment, even the rankings of the Federal Reserve they're kind of stuck in their tracks right now. And what that basically means, what I'm saying is, even an entity with all the information, data, and oversight of the Federal Reserve isn't sure what direction to go with the economy. Should we cut rates? Should we hold rates? Should we raise rates? There's so many moving parts right now in the economic system that it's difficult to take priority on what direction to go. And that is spilling over to the banking system and into lenders, into business lenders, because the Federal Reserve's policies around quantitative easing or tightening, higher or lower interest rates deeply affects banks' business. Deeply. First off, this is really where banks are getting their money. So the cost is affecting their costs, and it affects their products because they're going to obviously pass the cost along to us as we borrow. The Federal Reserve is, really the place that's pushing the money into the economy, into the banking system, and liquidating the banking system and creating that liquidity. And the banking system is then passing it on to us, kind of like retailers. So if the Federal Reserve is stuck in their tracks and trying to figure out what direction to go in and how to prioritize the economy, then that means business lenders, banks, and lenders are going to have similar problems. So that's one major thing that is truly impacting the lending environment around us is, the Federal Reserve is really in a tough spot, and banks are in a tight spot because rates are higher than they've been right now in over 20 years. even though historically they're not that high. But we've been at near zero or zero for nearly 20 plus years now. So we're at a point right now with the prime rate being, I believe, over 4 right now, if I'm not mistaken. That's significant. That's like well above what it's been for over 20 years. So banks have adjusted over this 20-year period of low to no, basically low to no central prime rate. They've been in a scenario where they've created their lending criteria around that. So they're trying to make a hard pivot because rates shot up in a year's time, pretty much. Federal Reserve 2022 and 2023 shot rates up to 20 plus year highs. So banks are still adjusting to 20 plus years of being able to have lending requirements and interest rates equivalent to near zero or at zero, to now a scenario where rates are, again, prime rate is +4, upper threes +4. So that's creating an environment right there where banks need to adjust. Banks still need to lend. It's the heart of their business model. But on the flip side, now you have a totally different environment. All of the other fallout changes that are impacting the economy are affecting the borrowers. So everything going on in the economy, like inflation, rate changes, unemployment rate changes and stuff like that, these things are impacting our ability to borrow. So it's changing the risk for business lenders, if that's making sense. It's changing the risk for them. And it's changing it in real time, real fast. So that's a problem. Previous losses taken by banks. We know that no-doc programs have kind of gone crazy. So you had a rush of people, as you're always going to have when the bar is lowered, and that threshold is lowered down and more people can access something, it's going to get watered down. And banks have taken some significant losses at a time where things are really tight for them. So banks are also taking losses in other areas not related to small business owners. A lot of banks that were exposed to commercial real estate, for instance, and had to deal with the fallout from work from home and office spaces becoming vacant and so many different defaults in the commercial real estate space ties into the business lending of that same institution, because it's two different books, but it's one institution. All of that is counted under one. So if there's a huge strain over here, you can believe that there's going to be a huge strain in other capacities of their lending, or their other lending capacities. So that's another one. FinTech enhanced verification methods. So we just kind of touched on that as well. Technology and financial technology has changed the game as well. Banks are getting less and less, at least decent sized one. This isn't coming to the smaller banks as much as fast, but decent sized financial institutions are less and less likely to have to take the risk of no-doc programs the same anymore. Financial technology is changing where there's enhanced and expedited verification methods that, instead of needing you to provide your tax returns and tax information, they're just plugging right into the IRS. Instead of needing to verify your income through W-2s and check stubs, they're plugging in and connecting portals to the payroll companies. So I don't know if you guys have encountered that yet, but there's technology and fintech companies that are starting to provide connections and technology to payroll now. And you're not seeing it full scale adopted yet, but I assure you it's something that's actually happening and coming, where they don't need to, take your word for it or take the risk of you having altered documentation, et cetera. What they're doing right now is they're getting into the position or already at a point where they're just plugging right into the payroll companies. Because most of us are getting payroll is being handled through a handful of companies. It's not like a million companies are doing payroll. So a lot of the larger payroll providers are plugging into these fintech companies, and these lenders are tying into the fintech companies. And so you'll mess around and do an application, and then they'll surprise you and say, okay, look, I need you to plug in your information here. We're just going to pull your payroll. So when you look at a note, and this includes background checks, account linkage, et cetera, when you look at an environment that's changing where they don't have to rely on you word of mouth through your application, they don't have to rely on, pay stubs and you providing paper documentation and going through that method and taking the risk. They're going to plug right into the source now. They're going to plug right into a background check. They're going to verify your employment by just checking right into it. They're going to plug into the payroll and check right into it. Same thing they're going to do with, the IRS and the taxes. They're going to plug right into these things. And that's a huge ball game shift on no doc funding because truthfully speaking, many of us fluff our numbers when we do no doc funding. We could just be honest. A lot of us fluff our numbers and a lot of us wouldn't get approved or would not get approved for as much if we didn't fluff it. And so it's not ethical. It's not ideal. I'm not advocating for it, but let's be honest. We got to be honest about it. Most of us, if most of us had the kind of numbers we were putting down on these applications, we probably wouldn't even need no doc funding. Let's just be honest. A lot of us are putting 6 figures down in income, 6 figures in business revenues or more. If that was really the case, how many of us would really need no doc funding in such a dire state? Let's just be real. So that's a huge change that's coming or has already taken place, and that will start to have broader scale adoption. So how do you find no doc programs with some of these changes that are coming in? The greatest resource for no doc funding programs has been the internet. Content and channels like mine, other content creators have built entire channels and, followings and brands just providing this information. So I'm not going to go into the weeds in this particular video, of all the different banks that offer these different things right now. I probably will do something like that in the future just to kind of provide it to my pioneers directly, and with my own touch and my own take on it. But at the moment, I'm not going to do that. What I'm going to say is continuing to follow quality content creators that are putting out that information is one place that is still true and tested. Honestly, the next best way to empower yourself, for those of you who are not either lazy or so damn busy that you can't do this for yourself, building more and more banking relationships. This is a lot more something I want to encourage is you can find no doc programs by tapping into the financial institutions that are in your backyard. Large national ones, all the way down to the mom and pop ones that only have a few branches. This is going to be the ideal way to find out about these programs because you have to remember the gap that the internet and content creators have. There's 4,000 plus financial institutions in this country. Absolutely nobody's going to cover those bases at that scale. It's not about to happen anytime soon. Technology is advancing, and as information keeps getting put out, people accumulate data. We might look up one day and there'll be a 4,000 plus master list, because I've seen some lists of dozens to even hundreds of financial institutions offering either no doc or 0% financing, etc. But to be completely honest, the kind of, digging and verification it takes to find no doc programs. What's up, PNR Connected? I just wanted to say what's up to you. I see you finally made it in, or if you've been in the whole time, good to see you, my guy. But finding these no doc programs, the best option you're going to have besides just following content creators and doing your general internet searches is really going to be going in and connecting with, or calling up or going into these institutions directly. And again, if you're not lazy or so damn busy where you can't do it, it's really ideal for you to do that so you can get firsthand data on what they offer and what the details of their no doc programs are. So I fumbled into one myself, and I'm going to shoot a whole other video about it because this is an interesting full-scale story. But I fumbled into one just looking for 0% business credit card at an institution that's regional to the Southeast. I'm not going to say they're completely mom and pop because they're across a couple of different states in the Southeast. But, I went there to start the personal and business banking relationship in order to give myself a good segue into the business credit card and, have a better approval odds and higher limits, all of that good stuff. And I ended up sitting with the branch manager to get that stuff situated. And she ended up explaining to me voluntarily that they had a no doc business line of credit up to, I believe, $50,000, if my memory serves me right. So I'm like, light bulb, cool. I came in here just for the business credit card. And now I'm fumbling into the fact that there's a full scale business line of credit option available. And she talked about how the business credit card can be packaged or rolled into the business line of credit. So whatever balance I have on that business credit card, I can roll into my line of credit. And that would basically be my outing if I haven't paid that business credit card off to have a better repayment option on it, as well as more available credit. So this is the type of opportunities that can be available if you just take the time to go into these institutions and find out what they have to offer. I just happened to fumble across them while they were making a couple mergers, going from a small bank to trying to graduate into a real regional size player. So they're trying to do big bank gains with their business funding. And so I just happened to stumble across that. This wasn't something on the internet. This wasn't something Google, no content creators covering it. So I want you to understand, if you really want to tap into how to find these no doc, low doc programs, you really need to just go into the financial institutions in your area or in your surrounding area and talk to them and see what they have available. Every bank is unique. Every bank is unique. So you never know what they're going to have, until you go in and talk to them. And really trying to rely solely on us as content creators on the internet is really not the best plan. Yes, we're going to curate and bring you quality information, save you time, etc. I'm not saying that we're not a good resource, but I am going to be honest. My goal on this channel is really to empower you to be able to do as much on your own as you can. And this is just an ideal way to go about it. Build out these relationships firsthand and do your own due diligence. Application sequences and what to say if applying for, no doc, low doc business funding programs. So application sequence is not rocket science if you've been in the space. You basically want to go by what banks the bureau is pulling from, and ideally you're going to go in a sequence that allows you to pull from a bank per bureau, and so pull from a bank from Equifax, pull from Experian, pull from a TransUnion, and layer that out. You also want to do your sequence based on the inquiry sensitivity of that bank. So examples: Chase Bank, very inquiry sensitive; Amex, not so much. So you want to kind of understand the financial institution. You want to understand what bureaus they're pulling from if they're inquiry sensitive. This is, again, information that you can get from quality content creators. You can also get some of this information from the actual institution themselves. Maybe not the inquiry sensitivity part. That's not something a bank's going to give off. But you can get it. You can call up sometimes and get the actual bureau they're pulling from. Now, banks that are, especially the larger ones, tend to pull from various bureaus based on regions. And then if they just want to switch things up, they'll pull from a different bureau. So sequence-wise, honestly, you're playing a little bit of a gamble, a little bit of Russian roulette, because even if the data you get at that time was good at the time it was put out, these banks are smart and they have the resources to move things around and keep from being too predictable and being able to be exploited in their application process. Now, as far as things to say, I just wanted to touch on this briefly because I know some of you are applying for your own business funding and you're not just going through some company that's doing a lot of that for you. You need to be very productive when you're applying, requesting for higher limits, or doing reconsideration on how you talk to these companies and what you say to these lenders and these underwriters when you're dealing with them. The biggest, broader caveat I can provide for you is to express a focus on productivity. What I mean by that is, if I'm applying for business lending, especially if I'm looking for highest limits possible, or I'm doing reconsideration where I've already been denied, and I look at it and say, I should have been approved, or you're just fighting for it. Banks are looking for high levels of activity, so usage on whatever funding they're putting out for you, especially if it's lines of credit. Like business loans, they're going to get their money regardless, but we're usually looking at business credit cards or business lines of credit, which are both lines of credit that require usage. That means you can get access to these funding sources and technically not use them. So banks are going to be looking for high use case, productive use case, and repayment. So they want to see that you're going to use significant amounts of the money they're lending you. They want to see that it's going to some productive project that you have that's going to grow your business, create more revenue, et cetera, add value. And then they want to see that this is something that's going to turn around and pay back on time, or beforehand. So you want to gear all of your conversations during the application process, during your reconsideration process. If you're applying for higher limits and you end up talking to a person trying to get that accomplished, you want to keep those pillars in mind. How do I phrase this based on my business model and business activity to show high activity, show productive use of activity, and show repayment? If you can express that when you're dealing with an actual individual that's taking that information, they may be maybe not the underwriters themselves, but they're the one helping to process the loan. It could be the banker. It could be, client service specialist in the backdrop. You want to make sure that you're presenting yourself effectively. This is what a lot of those funding companies are providing for you that you could be missing out on when you go to do it yourself. they already know the scripts and verbiage to use when they're dealing with these banks, because they're usually, the legitimate ones have done this at scale. So they know what the banks are looking to hear and what works based on previous use cases, previous failed and successful applications. You're usually going at this alone. And so that's a little different for you trying to figure out what to say and how to say it. But I wanted to give you at least those quick nuggets of foundation. Make sure that you're going to use significant amounts of the money. It's going to go to something productive and relevant to the business, and that it's going to be able to be repaid. What you're putting that money into is going to provide some kind of dividend in return. Big banks versus small banks. This is another one I want to touch on really quickly before we proceed to more on the SBA funding and the no-doc funding. Big banks versus small banks. There's a huge rift on where to go between these two styles of institutions when it comes to business lending, especially no-doc. I'm going to give you a couple quick perspectives and some insight. Small banks tend to get a lot of praise as the best place to go a lot of times. And then big banks get all of the commercial attention, meaning all of the internet attention, right? You're seeing the YouTube and the Instagram posts, TikToks on Chase Bank, no funding, BOA, no funding this, PNC, no funding programs, etc. Big banks work off of scale. What that means for you when you're applying for business lending is big banks that are offering no to low documentation funding are doing so off of scale and probabilities and creating avatars. So they have the kind of technology and resources, and they're dealing with so many applicants and potential borrowers. They don't have time to do all of the verification by hand that a small bank's going to want to do. They're not going to be looking through. They have to be able to do systems and processes to deal with the scale. So that basically means that they're going to have to find ways without verifying all these different documents and all these different, data points on the application. They're going to have to find a way to take that information in, run it into some kind of, they're going to have to bucket it or segment it, and then turn around and run it on probabilities and say, okay, this person lives in this zip code. This is their educational level. This is their income level. This is their credit score. This is their this is their that. This is their this. Pull out of that together and then run it across all of the applicants and all of the borrowers they have and say, okay, based on these data points, people like this person have had this rate of default. That's how big banks are operating. And I hope you're paying attention, maybe taking mental or physical notes. But that is when you're looking at no doc, low doc funding or business funding, period. Big bank versus small bank, that is your deciding or your divisive factor. Big banks are running off of a lot more of a system based on scale, probabilities. Small banks are still the type that are going to flat out pull documents because they're not dealing with nearly the scale and the amount of applications. So there's still human underwriting. There's still individuals. So that's the deciding factor between big and small banks. And so for you, and even with low to no documentation programs, right? I know I'm saying like, oh, the small banks are going to want to pull docs. Even in no to low documentation processes, small banks are much more likely to want to get some kind of verification of some kind. Big banks will take almost everything on your application, some virtual checks. They have the ability to double check Secretary of State or these other resources to verify, is the business real? Is this really the owner? Et cetera, et cetera, et cetera. Even no doc programs on small banks, they may still have you furnishing, Secretary of State docs and things of that nature. They may not do income verification if they have a legitimate no doc program. They may, or if it's a low doc program, maybe they'll take something basic for it versus the extensive documentation of a full doc program. But I wanted to give you the understanding. Big bank versus smaller bank. Big banks are working on scale and probabilities. They just don't have the time to do the due diligence of pulling all of those documents for all their applicants. They're looking to try to get as many of these applicants weeded through and get the money out to the ones that qualify the best. And they have a different system to go about verifying and minimizing their risk. So they're using a lot of technology, a lot of systems, a lot of segments, a lot of probabilities, a lot of bucketing. So they're, and I'm gonna do another video, a sequence of videos, and maybe a live stream around that too, because there's so much to cover around how big banks are doing business and how they look at us and segment us off. And that information can help us build better relationships with banks. Yes, AI is making, one of my pioneers says AI is making most of big banks' decisions. AI is playing a huge role. And it's really, AI is a derivative of scale and probabilities. That's all it is. AI is literally what I'm talking about is what AI is all about and what it's for in this arena. It's taking what banks were already doing prior to the emergence of AI as we are seeing it today, which is scale and probabilities. Banks have been, this is where the whole internal score thing comes from, like the Navy Federal excitement around internal scores. That's something that all decent sized banks have. Navy Federal has gotten a rap because they actually kind of put it out there and got an actual score and all this other stuff. But all banks have segments and potentials and buckets they put us in. And so AI is just facilitating a more seamless technology that's doing these things faster for them. But that's all it is scale and probabilities. And so, banks are inputting the things they're looking for, the things they're trying to avoid. And now there's systems and technologies that can do this stuff at scale, repeatedly, fast. So that's really all it's boiling down to. So as far as the big bank, small bank, there's no right or wrong. The gift with big banks, scale and probability allows you to just basically verbalize your income. And then verbalizing your income or taking it on an application, if you have other data points that substantiate it, like where you live, your education level, your career path, if they're connected, if they're already banking with you, your bank account relationships and activity, if all of that stuff is congruent, then you can get away with whatever you're saying and maybe even get away with some fluff on your income. You may only make 95 a year. You tell them you make 115. You probably can get away with it if you have all of the other, data points lined up. That's how big banks are looking at it. They don't have time to take all of the pay stubs, W-2s, and IRS transcripting and all of that. So they're going to say, okay, you say you make 115, but you live over here where the average person is making 45 a year. You got a job career that even the median income there is 50 a year or 45 a year. Your bank account information only shows this, such and such, and your credit report doesn't show this, that, and the third. They're looking at congruency. Small banks, on the other hand, the gift of small banks, yes, they're going to be more tedious because they have time to be. But small banks usually have their own underwriting. It's a lot more common for smaller banks, and big banks have their own in-house underwriting a lot of times too. It's really regional and mid-sized banks that are using like the E-line financials, right? Small banks, if they're really to the smaller side, like they're literally only in your city or only in the metro area, they're going to be the ones that still have in-house human underwriting. That's going to be aggravating because they're still going to probably require a lot of stuff. And it also leaves room for error on a different level. I'm going to shoot a whole video on how that ended up blowing up on me with one of these banks. But the gift is you can go to these banks at scale minus the inquiries. You can go to a dozen small banks as long as you don't have the inquiries piling up on you. You can go to a dozen small banks that are all going to underwrite in-house and get $10,000, $15,000, $20,000 a pop from them if you play it right. And so with big banks, their systems are so big and broad, even though they're underwriting themselves, like in-house, they're connected through so many other systems. BOA and Chase Bank knows and shares all of this data with each other. That's where stuff like EWS and early warning system comes from. These bigger banks are interwoven together. Amex, Chase, BOA, they all pulling from higher, data sources. Like LexisNexis is a good example. I shot a really good video probably going on a year ago, last October, with Bank of America denying me for a business credit card, basically because in part they told me they pulled LexisNexis. And even though I had all this other stuff kind of swept under the rug as far as all of the different funding I had from like Chase Bank and these other banks, LexisNexis is a whole, mothership to all credit reporting and data reporting agencies. So they still found out about a lot of the other business funding I have at other banks, and they just weren't comfortable. So even though big banks are underwriting autonomously, they're still very interconnected. And so you're very limited in your ability to go from one of them to the next, especially over time. If you do it in one sequence, you probably can get away with it. But if you're doing this weeks apart, months apart, then you're usually going to have a hard time. Small banks are still doing in-house underwriting, pulling from basic credit bureaus. They don't have the means or resources to typically go all the way up to the chain to LexisNexis and all of that. And they're doing underwriting in-house. And so there's pros and cons on each side between big bank and small bank. And hopefully that gave you some insight between those. Appreciate it, my guy. Of course, I bring y'all that unique perspective around these things. And that's why y'all tune in, man. How to exit no doc funding. So this is important. This is important. So when you start talking about no to low doc funding, the goal is hopefully to graduate up to stuff like SBA funding or full doc traditional bank funding. The reason for that is the security in these funding methods like SBA allows banks to provide the best rates and terms. So honestly, we don't want to make a living off no doc funding forever. We really don't. You want to use no doc funding as a segue to get everything off the ground, operational, and sustained and scaled to graduate into SBA funding and other full-scale, full documentation, conventional funding. So you need to exit no doc funding effectively to do so. You have to survive it. And not enough people talk about this, but for every funding company and funding guru on the internet that's talking about the success they've had and how they've got this person 500,000 and this person $1 million and this person 250, there's dozens of people who are getting this funding that are falling apart behind the scenes because it is so much more to it than people talk about. It is not easy work managing this money, especially the short-term repayment circumstances that no doc funding typically is. That 0% runs out, that window of time passes, and whatever it is that you got this money for, and if you were even responsible enough to use it for business means, because that's a whole other conversation. You get this no doc funding. Most of the time is 0% business credit cards for 6 to 18 months. Maybe if you're lucky and you're really advanced, you got no doc business lines of credit, which is a little bit easier to manage because of the repayment structure. But the 0% business credit card thing is rough. It's really rough because, for one, you have to be responsible enough to deploy it into a real business venture. Once you get past that, there has to be what you're deploying in it has to work. And so if you are relying on a real estate project, if you're relying on, buying or purchasing a franchise, if you're starting an organic business that isn't proven yet, and you're using 0% business credit cards to fund it, you are putting yourself in a position where if the timing is off even by a couple to a few months, you can be in trouble. You're doing a fix and flip, you're doing a BRRRR, a buy, rehab, rent, repeat process with real estate. So you're buying rental properties, fixing them up and turning them into, full scale rentals, and then planning on pulling the cash out on the back end. So many different mechanisms and so many different points of failure exist with no 0% business credit cards, no doc funding. And it's important to address this in advance. What I'm saying by this is basically the goal is to graduate into SBA level full doc funding. You have to keep your financials, your business, your money management, all that has to stay in place and actually scale up in order to get to this full documentation SBA side of the spectrum. So here's some takeaways of value. Number one, make sure when you use no doc funding that you're using it on projects that have high potential fast turnovers. What do I mean when I say that? Real estate can be cool as long as it works. Fix and flips, rentals can be cool. Rentals with the intent to refinance after it can work. Because if you do the job right, this is something you can do in 3 to 6 months most of the time. You have to keep in mind that there's a lot of factors at play that can turn these projects into longer projects or complete failures. But I mean, that's the risk we're taking as entrepreneurs. So fix and flips, rental properties are cool because that's 3 to 6 month windows where you can get the property renovated, and if it's flipped, you can either get it sold, or if it's going to be a rental, you can get it rented, usually within a 3 to 6 month time frame if you're diligent and got the right stuff in place. Vending machine businesses and things like that are another great avenue to go. ATM businesses, things that can be set up in relative short windows of time, weeks to couple to a few months, it can immediately start bringing in revenue. And I'm going to get to the basis as to why I'm giving you these recommendations towards the end. But I'm just going to keep throwing these out for a second. So vending machines, rental properties, fix and flips. If you're looking into a business that is not proven, so not a franchise, not real estate, you're doing your own ground up business model, then it needs to be something that has the ability to turn over at scale quickly. And what I mean at scale doesn't mean that you're making hundreds of thousands of dollars immediately. What I mean by that is you can make a good sizable income that can help cover your debt servicing on the debt and hopefully also surplus. So the goal again is to position yourself to be able to take no doc funding, deploy it into a business project that will start immediately allowing you to show real revenues, and you can document it early as possible. Because the longer you document it and the sooner you get on that clock is ticking towards qualifying for SBA funding, full scale, full doc conventional funding, the high quality stuff, the best rates and the best terms. So the goal is to get into business models that don't have these extended turnover time frames, where the ramp up is 6 months, a year and a half. That's why you got to be careful with some franchises, especially if it's brick and mortar, because you could end up in a scenario where you did a 0% no doc funding program. You got 12 months on that money, and it's going to take 12 to 18 months for it to get off the ground or to get fully operational. That's not including you actually being profitable or, is it going to work? How is it going to make the kind of revenue and numbers you thought it was going to make or the projections you had? A lot to consider. So the point with the no doc funding, low to no doc funding, make sure you deploy it. It does not have to be your core business model, by the way. This is something else I want to put out there for y'all. It does not have to be your core business model. A lot of people are so fixated on doing that one business model or that one business idea they had. You can use stuff like rental real estate, fix and flips to stabilize the no doc funding and create revenue and create real business activity that you can document to get you in position for your true business model. This is actually something I'm practicing. I'm using my no doc funding and low doc funding on things that aren't my core model per se to get me in position and to scale me into the full scale documentation programs. I'm in a position that's unique where, I could technically do full documentation programs now, but I like no doc because of the scale. I can get access to a lot of capital relatively quickly with less headache and go through my bumps and bruises of the various business projects I'm working on and the successes and the failures that are going to come with them without having to deal with all of the scrutiny and the long lag of full documentation programs. That haven't been said. For you, just be mindful of being too fixated on your golden business model, whatever that is. All right. Be willing to use vending machines, fix and flips, rental property, stuff that's going to spin off cash flow, short turnover times. And again, the next one I'm going to give you can potentially build equity. That's another reason real estate is a really attractive one. And it doesn't have to be your core model. Why is the equity side so attractive? Well, the equity side of this can be attractive because, again, if you use real estate as an example, you get $50,000 in no doc funding, you put it into a rental, a buy and hold, you do the rehab, it ends up getting enough equity to not only pay off the debt or allow you to pull out for the debt, but it's still growing in equity as time goes on. So it becomes a continuous, not only is it providing a cash flow that you can document and allow you to help put you in position for full documentation funding, but the equity position allows you to have something to tap in the future. You know what I'm saying? If things change or pan out in a way where you need access to capital, this little rental property is continuing even through the rental income paying down on the mortgage or actually being a property that's appreciating in the market. Having a business model that continues to provide lendability or having a business model that continues to provide equity gives you that backstop to continue to have something to borrow from without having to go through extensive lending programs to do it. Does that make sense? So, you want to get something that's going to provide cash flow, has a quick turnover time relative to your funding, right? So if you got 12 months on your funding before the 0% is over, then you want something hopefully no more than 6 to 9 months before it's fully operational, right? You want to give yourself a cushion. The last thing I'm going to tell you on this particular segment is when you're pulling no-doc funding, try to hold some percentage of it for reserves and or debt servicing. If you pull $100,000 in business no documentation funding, you might want to save 10 or 15% of it for reserves or debt servicing, meaning to cover the debt payments while you're working on your project. This is a practice that I've had since before I was doing business funding. This goes back for me when I was doing personal loans at one point in time for various business ventures. Before I even knew all this other stuff was a thing, I would borrow X amount of dollars and I would literally save a certain amount to cover my debt servicing for X amount of months just to hold me over so that pressure is not there. So definitely be mindful to try to either get enough funding where you get what you need for your project and leave yourself 10 or 15% of reserves or more towards the debt servicing or reserves. That is my last tip on that topic. So ultimately, to close this out, huge changes coming to SBA. And those changes are going to trickle out to the conventional market. For those of you who, my pioneers and even my new viewers that catch this, that have made it this far, leave your comments down below and let me know what you're thinking around these changes. And let me know what you're thinking about everything that I covered on here. If you have any questions or thoughts, let me know where you are with your existing business lending, sequences or your requests, your journey in general. Where are you with it? What are some of the projects you're working on? Is it real estate? Is it an organic business idea? Is it a franchise? What is it that you're working towards when it comes to, the business funding segment, where you need business funding rather? And ultimately, to surmise all of this, the environment is getting rough for banks, and it's getting rough for the credit markets as a whole. The risk environment is changing. It is important for you to stay on top of it to make sure that you are continuing to get access to the funding that you need. You're ahead of the game on what's going to be needed for it, so you have the best chance of success. And that was the point of this live stream, is to just perk your ears up, let you know that things are shifting, that we may be completely out of the realm for easy no-doc funding and entering a realm and already in a realm where you got to be prepared to provide something to these banks. Relationship banking is going to be key. Having some existing assets or existing something of substance that a bank can lean on is going to be important. And having congruency. If you're going to go to no-doc, low-doc funding route and you're expecting these banks to rely on you, you're providing what you're providing on the application, then you got to be sure they're going to cross-reference that information. So just making sure that you are prepared to have your ducks in a row on the back end. As y'all can tell, I'm pushing through this, not feeling the best, so I'm going to close this out. But I appreciate every single one of y'all that stayed on live. All my pioneers, my true time tested pioneers, PNR Connected, Credit Cousin, if you still there. I appreciate each and every one of y'all. My new viewers that stuck this out, if you're catching the replay, comment, like, share, subscribe, support the channel so the channel can keep supporting you, and also put yourself in a position to get access to more of this content so you can continue to build up. And sharing this obviously gets you providing quality information to other people around you who are hopefully like-minded and on this journey with you. So I'm in the first stage, 0% credit cards and business lines of credit phase. Yeah, I mean, that's where it's at right now, PNR. definitely a good option for a good little while on your journey. My encouragement for all of you is have a plan with that money. Have a plan that's effective. Use the points that I gave you in this live stream to make sure that it scales you into full documentation funding. You want to graduate to that point at some point in time. You want the headache of having to supply docs because that means you're in a whole nother ball game, whole nother stratosphere with your business, with your income, with your lifestyle, with your finances. You're in a whole nother stratosphere when you're in the full documentation realm. That means you got real things going on. So that's somewhere you want to get. That's a problem you want to have. But other than that, I appreciate every single one of y'all. If y'all want to tie in with me on Instagram, that'll be down below once I get everything hooked on to the description section. And also an opportunity to work with me one-on-one if you want somebody to actually take the quality content you're getting on this channel and actually apply it to your personal circumstances. You got an opportunity to do that. You can either comment or get in the link, the description down below, and there'll be a link there to do so. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon. Ah.